Welcome everyone to our webinar series. I'm Srinivas Kunte, Director at CFA Institute. I'll be moderating today's session. I don't know how many of you were there in the last webinar that I moderated, but it was on derivative investing and hedge funds. So hedge funds is very much active investing, but at the other extreme of this is passive investing. Many of you may have read the book Common Sense Investing by Jack Bogle. The late Jack Bogle had one iron law of investing, in which he said the average investor always loses. But this investor can turn a loser's game in investing to a winner's game by embracing passive. Today's webinar is about passive and index investing, and it is also about asset allocation. We have a lot of ground to cover, but I am sure we are with the safe and very experienced hands of a veteran expert and practitioner, Tim Edwards. Tim is Managing Director of Index Investment Strategy for S&P Dow Jones. Not only is Tim a veteran in investing, but he's a distinguished veteran. Tim holds a doctorate in pure mathematics from University College of London. You can look at his bio on the web page, but in the interest of time, let's quickly jump to the topic. And before that, a few housekeeping instructions. We've got a lot of ground to cover, so keep your questions very brief and have them keep them on the conceptual side of things. I reached out to many of you, for questions in advance, and thank you so much. So we've got the hopper full. There's a couple of other things. Those of you who are new to this, try to put your questions on the Q&A box. Please do not put questions anywhere else. We will not look at questions which are not there in the Q&A box. There will be a survey at the end of the webinar or towards the end of the webinar. Harshad will be administering the survey. And if there's anything at all in terms of the voice not being clear, etc., those questions will also be addressed by Harshad, and Abhishek Kunagri is also there on this call. Lastly, what I would request you to do is to tell your colleagues, and for those who may want to get off early from this webinar, the recorded version of this webinar will always be available later. Thank you so very much, and welcome, Tim. All over to you.
Thank you, and let me just start by saying that it's an honor. So thank you very much for the CFA Institute for inviting me and giving me an opportunity to present. And thanks to all of you who have connected and engaged with the topic, and hopefully we'll get some interesting insights for you. And I'm really looking forward to the Q&A session at the end. So I gather the questions will be moderated, and I really look forward to hearing your questions or comments at the end. So with that, the title of this talk, Practitioners' Insights, Asset Allocation and Index Investing in a Post-COVID World. I do hope we have a post-COVID world. I'm sure we will do. And we'll have kind of two perspectives. One will be quite short-term, looking at what's been happening this year, and the other perspective will be long-term and thinking about the notions of not just asset allocation, but how to do asset allocation in the context of active or passive. In terms of the agenda, as Srinivas said, there's quite a lot to get through, and this is what I'm hoping we'll get through today in about 40 minutes or so. The first point is I shall be making the case of the value of diversification to Indian equity investors. And in that, I'm really talking about asset class diversification. And what we'll be effectively exploring is the notion that, in fact, just even a simple allocation to US equities can go a long way to achieving globally diversified exposures. But we'll also talk about why you might want to do that in the first place, both from a long-term perspective and from the current perspective. And that sort of leads to the second part of the topic, is just to review some of the major trends that have been driving markets this year. And we'll see very clearly how that fits into the notion of international diversification. Next, we'll take on an important topic. We'll use the US as the sort of study case for this, in part because that will fit well into the earlier discussions. And we're going to ask, where is active management required, and in particular, is it always required, or is it sometimes the case that actually just taking a passive exposure can do the majority of the work for you? And actually, we'll explore whether the more important decision is not so much which fund do you pick, but where do you invest globally. Then we'll talk a little bit, not too much, a little bit about the trends and developments in the actual indexing business. So this will be an overreaching theme, is talking about the different types of indices that there are, some that are very old and established and have long histories, some that are newer, and we'll use that concept to talk about one of the more difficult topics within the sort of framework that you will all have studied in the CFA, around the notion of gold-based portfolio construction, and how that can sometimes fit into an index framework. Finally, we'll just talk about some practical applications. I'll mention a little bit about implementation, liquidity. We'll draw some conclusions, and then the bit we're all waiting for, the Q&A, will follow. So that's the agenda. Even before we start on it, there are a few preliminaries. So just 3 slides, kind of setting the scene for what's about to come. The first one is, I wanted to just start off with this. If you're an Indian equity investor, you may well ask, what is the point in international diversification? In India, you have one of the fastest growing economies in the world, and you have one of the best performing stock markets around the world. So I was careful in picking the start date for this, by the way. So I picked May 2002, which is kind of a period when this comparison looks particularly flattering. And what you have here is a range of all our indices for major countries and economies around the world, both developed and so-called emerging, and their performance in Indian rupees, I should say. So all this, whether it was US dollars for the US or pound sterling for the UK, converting that performance into Indian rupees, so something an Indian investor would experience, and plotting the total return. And again, one of those preliminaries, total return or price return are names for indices. Total return includes dividends you might receive from the stock as well as the price appreciation. Price return is just what happens to you with the price ignoring the dividends. And we'll use both kinds of indices today. But this is total return. And as you can see, India's equities have performed fantastically well. Again, so this is our broad market indices. It's covering pretty much the whole of the available opportunity set. So all the stocks, some very loose minimums on, a certain amount of, they need to be listed, they need a minimum amount of trading volume. But basically this is the whole stock market, our broad market index for a lot of different countries. And you can see, okay, maybe Denmark, but how would you know? The key point is that for Indian investors, the case for diversification historically has been quite a poor one, at least from a returns perspective. You could have done very little damage by just staying in domestic equities. However, even though that performance was very good, you did see, and you can see it on that red line, you can see in 2008, you can see in 2015, and you can see this year, there have been moments and times when you certainly saw large losses. So moving from our broad market indices to one that has a slightly longer history, the S&P BSE Sensex was first published in 1986. So that's got the longest history that we have for the Indian equity market. And here, what this is showing you is just on a price basis, so ignoring dividends, if you were invested at the high, what could have happened to you? How far or how much loss might you see from the high point down to the low? And what you can see is that once every 5-6 years, something like that, at least once a decade, you're looking at point to low point losses, high point to low point of 30, 40, 50% coming quite regularly. And of course, for the end investor, sitting on a position that's down by 50% is really challenging. It can be challenging in the context of planning for the future. It can be challenging if you are just thinking about managing the behavioral challenge of risk. And what I mean by that is, in many cases, if we own something and it goes down by 50%, it's our instinct to sell at that point. We've had the pain, too much pain, and so we sell, and what of course happens then is you miss out on the recovery, and so you're very, very damaged by drawdowns. So that's, I guess, one of the first obvious points. Is there some way that you can diversify, retaining that return profile, but maybe mitigating some of the drawdowns? And the final preliminary, this slide could have come pretty much anywhere in the presentation. I'll do it now and just cover a few main points on it. And in fact, what you'll see is that as the presentation continues, we'll sort of move from the higher to the lower in terms of the indices that we talk about. But I just wanted to cover this off. Okay, so this is a schematic, a taxonomy, if you like, for indices that I thought you might find useful for the rest of the talk. So the most famous kind of index is I call them household names: S&P 500, the Dow, the Sensex. These are typically a basket of so-called blue chips. They might be fixed in number, so it's 30 in the Dow, 30 in the Sensex, 500 in the S&P 500. And they're typically representative of a particular country or an exchange, right? All the stocks listed on an exchange, not all of the big ones. And we'll often talk about these in part because they tend to be the most liquid. They tend to have a lot of products associated to them. They tend to have the longest history. In fact, the Dow has the longest history of just about any index. Currently, it has over 100, in fact, 124 years of history. So great for study, but it won't represent the whole opportunity set, just the top 30 stocks or so. The next type of index that we'll talk about is kind of broad market. So examples would be the ones that I showed you for India and Denmark, all those different countries. That's showing you the whole opportunity set of a market. They will represent a whole asset class or a whole geography, and they are nearly always capitalization weighted. So larger companies take a larger weight, smaller companies take a smaller weight, reflecting their dominance or lack of it in the actual local economy. And then especially when we talk about the performance this year, you also like to talk about particular market segments. So for example, industries like airlines or information technology, market sectors, or large, mid, small parts of the market. These are also nearly always capitalization weighted as well, but they're not so much broad indices, they're more specific. They're focusing on particular kinds of returns. And then finally, we will talk about some of these factor-based or goals-based indices, sometimes called smart beta, which are, rather than picking stocks based on their geography or their industry, it's actually looking for certain characteristics that might be, for example, lower risk, it might be a higher dividend, or it might be just weighting the index in a different way. So equal weight, for example, instead of capitalization weight. So those are the preliminaries, and those are the kinds of indices and how they're different. And now we should get to work with first, the value of diversification for Indian equity investors. Now, there's a lot of different ways I could have addressed this. I tried to keep it reasonably simple. And I picked 15 years, and of course I could have picked a very different time horizon for this. The reason I picked 15 years was one, because as you recall, it was a pretty good period for Indian stocks, and I didn't want to be picking a bad period. And secondly, it's also the history that we have for our 10-year Indian sovereign bond index. So I wanted to have a fixed income component here. So over the last 15 years, ending in June, here are some risk return profiles. So one of, US and the Sensex both performing pretty well in terms of total return, around 13% per annum. Gold doing a little bit better, a lot of that coming recently, but I included that as a potential thing that I thought some of you might have considered or diversified into, and then Indian sovereign bonds. And from a pure return perspective, there's no obvious case for diversification. You know, maybe you do slightly better with gold, but not a big difference. However, from a volatility perspective, we're going to see a huge difference. So what we did is we simulated all possible portfolios, changing by 5% weights that you could have built out of these 4 assets, rebalanced monthly, and just have a look at the risk and return profiles that you could have generated through diversification. And if you do that, you'll get something like this. And there you can see the astonishing range of returns and volatilities that you can generate. But what I really want to focus on, and this may be clear if I can move my cursor, perhaps you can see this. So if you start off with a pure investment in Indian equity, just about any change whatsoever is going to not hugely change the return, might increase it a bit, might decrease it a bit, but it's going to hugely change the volatility. And that's the real key to diversification. It is that ability to have things in your portfolio that take over the leadership when your favorite pieces perhaps aren't doing so well. And we can visualize this in terms of the drawdowns as well. So I picked this is sort of perhaps representative. There's lots of different combinations you can look at, but looking at a combination that was split equally between Indian and US equities for 80% of the portfolio. So 40% in the Sensex, 40% in the S&P 500, and then some diversifiers, 10% in gold, 10% in 10-year sovereigns. And you can see immediately the difference this makes in performance compared to a direct equity investment. The line of performance is much, much smoother, and those drawdowns are much less painful. And so, the value of diversification, to say it again, it's not just about return. It's about limiting drawdown, it's about limiting risk, and it's about having a more stable pattern of returns. Whenever you do something like this, I always get these in the Q&A, and people want to know, all right, that's a sample portfolio, what were the best ones? So I'm not going to spend any time on this. It's entirely engineered. It's historical, hypothetical. I built this 2 days ago, not 15 years ago, but just for the curious. So the one with the least drawdown, and in fact only fell a maximum of 4%, was an allocation that was mainly gold with a bit of Indian bonds. The one with the best risk-return ratio, the steepest capital market line, if you like, again, was biased towards the S&P 500 and 10-year sovereigns. Not going to say much about that, but every time I've ever done this, someone always asks me, what was the optimal portfolio? Well, from the different perspectives, here's what they are. That's 15 years. If we extend, if we just use the Sensex and we ignore bonds and we ignore gold, we can do a longer analysis. And I can kind of show you how that diversification is working in practice. So this is just using price indices. So as I said, the Sensex began publication in 1986. The S&P 500 has been running a little longer. That first launched in 1957. And converting it into Indian rupees and rebasing them to the same start point. Here's the Sensex versus the S&P 500. And you can see that post 2002 great performance. But what I really want to focus on is the idea that when one is outperforming, the other might be underperforming and vice versa. And so breaking that history down, on the right hand, what you can see is a ratio of those two indices normalized to 1. So when on the right hand side, when this is going down, that means that the US market is outperforming. When it's going up, that means India is outperforming. And what you can see straight away is some really clear trends, long periods where the US was outperforming India or vice versa. That's how diversification works. On the left-hand side, just in terms of annual returns, so you can get a sense of scale, you're getting, 7-6 year periods of double-digit 20-30% outperformance from one versus the other. And that's really how diversification works. A final thing on just sort of the asset allocation mix, but it'll lead into something we'll talk about later, is, okay, well, you know, so maybe I'm interested in that, but does it have capacity? Can I, you know, the Indian market is there, but what kind of capacity is there for me to invest outside? And the answer is that actually, if you look at the total market capitalization, there is plenty of opportunity out there. And we will talk more about this, but just looking at the total market cap, you know, compared to each other, gold, this is based on the World Gold Council figure. It's the value today of all the gold that's ever been mined ever, which I think is about 200,000 tons of gold, versus all the rest of the world equities, and versus Indian equities using the BMI, Indian sovereign bonds using our index, and the S&P 500. And one of the things you might notice here is that actually the S&P 500, that notion I was saying about the beginning, that actually it's a single way to get access to a lot of the global opportunity set. Okay, so that's you know, why you might diversify as an Indian investor. We'll move on to some more recent performance. So it has been an extraordinary year, record-breaking. March 2020, we saw the highest volatility in the S&P 500 of any month ever. The VIX went to its highest level ever. I mean, these really were extraordinary times. And you had very, very different performances in different countries. And you can see that here, just sort of illustrating the degree of dispersion. Some countries doing very well this year. Denmark is up, the Netherlands is up, China's been doing okay. Others have been more disappointing. The UK market is one in particular that's had a rough time, still down more than 20% since the start of the year. Latin America, some particularly poor performances. So there's going to be opportunities in picking and selecting, but actually the real opportunities this year weren't in picking countries, they were actually in picking industries. So this is using our global equity benchmarks, which are split into industries and sectors. And I wanted to highlight some of those that have been really key or real parts of the market that have been the focus of trading around the developments around COVID. So with spectacular performance, you have those companies that are not only unaffected by the virus, but also potentially benefiting from the way that we have changed our work patterns, our shopping patterns while in lockdown. So internet and direct marketing retail, companies like Amazon, companies like eBay, those that can continue to service consumers without storefronts. Software, another obvious one, but also biotechnology. And the overall information technology and healthcare sectors have been performing very strongly. Those that the market has picked on, again, pretty obvious: hotels, restaurants and leisure, energy, you know, huge major shift in the energy markets this year. And probably the most obvious piece of the market sensitive to the virus has been airlines. Incidentally, just yesterday, our airlines index rose 10% in a day, basically on the news from Moderna that they had a promising result in one of the vaccine trials. So this is absolute performance. If you go relative, looking at, you know, whether they were beating or underperforming the market, the picture gets even more striking. And what you see is, if you sort of split the year up into two parts, essentially, you know, up to say the end of March, when all the lockdowns were imposed, and then from there to now, which, you know, signs of recovery or managing that lockdown period. And you can see that those winners kept winning and the losers kept losing. So if you are looking for momentum, some of these industries are going to be really interesting. If you want to look at value, some of these industries, perhaps the ones that are underperformed, are going to be very interesting. And for the Indian investors' perspective, you really want to look internationally. So this is comparing the weights in each sector in the BSE 500, which is a basket of 500 stocks, just to make it apples to apples, versus the S&P 500. And you can see that if you want to get exposure to, you know, global healthcare, global IT, global communication services, which includes companies like Google, Twitter, and Facebook, they're largely American. And there isn't a lot of those sectors in the Indian market. There's just not a lot of companies there. So that's another reason to think about diversification, think about where you diversify. You know, moving to, just to make this a bit tangible, you know, picking on those industries that we just talked about, software, biotechnology, airlines, healthcare, if you look at the largest companies in each sector, they're nearly all American. They're not only American, but they're nearly all American. So if you want to get exposure to those global trends, then you probably need to look outside India. Reliance Industries there is making it into the top 5. So there is some representation. And to my earlier point that actually you can use the US as a way to access global industries, in part because it's very efficient to get exposure to the US rather than going down all the different countries, but in part because actually it's got really good coverage. So if you're focused on materials, maybe not so, but look at those on the right-hand side, those 3 sectors. So this is showing you how much of the world opportunity set in each sector you can capture with just the S&P 500. So healthcare, it's over half, communication services, 60%, IT, it is 2/3 of the world opportunity set you can capture with US investing. So, so this then gives, I think, a pretty decent thesis to at least consider or evaluate whether possibly an allocation to the US might be a useful diversification, might be a useful way to access certain trends that have been established very strongly this year. Now the question comes, should I be investing actively or passively? And I will come now, I will say, you're about to see the most important chart, I think, in this whole presentation. So if you haven't been paying attention, please do pay attention now. I shall try and do justice to what I'm about to show you, but it's a very important concept. Okay, stock picking is hard. Stock picking is particularly hard in the US, but stock picking is hard everywhere, and this is why. I'm about to tell you why. So how do we build this chart? What we did is we took all the companies that were ever a member of the S&P 500 over the last 20 years. So it's more than 500 companies because one's come in and out. And you look at all those companies and you look at their full period total return. So for most of those companies, it's how did they do over 20 years? For some, it was how did they do from 20 years ago until when they went bankrupt. For some, it's from their IPO 5 years ago, whenever it was, until now. But for most of them, it's a 20-year total return. And you measure all their total returns, and then you look at the distribution. Okay, so this bar here shows me that nearly 15% of companies went down 50 to 100%. Right, so the disappointment. And so on. So another 15 or so percent went down a little bit, 0 to 50%. The median company, nearly 20% of them went up a little bit over those 20 years. And in fact, the median company was just a little bit over 50%. The average company performance includes a small selection of companies, just around 5%, that delivered a more than 10x return. And these companies, there's not many of them, these little select companies include names like Apple and Microsoft and Amazon, they drove the market higher. And so the average and the market benchmark, which includes these very few, very extreme performers, does a lot better than the median. And in fact, in this data sample, 2/3 of stocks underperform the market. That's why it's hard to pick stocks that beat the market. Because if you pick any old stock, most likely you're going to be somewhere in here. Most stocks do okay. A very small selection of stocks do fantastically well. And the market is going to participate in the performance of those stocks, but you may not do. And this skew in stock returns is, I should say, not specific to the US, not specific to the last 20 years. This is a feature of companies. That gains for a stock, if it really starts to have a great success, the gains are almost unlimited. You know, over in this sample, Apple was up 30,000%. That's a practically unlimited gain. But the downside is limited. They can only lose 100%. And so it's natural to expect over the long term this kind of pattern to appear. And that's the argument, I think the most important argument, why, unless you have a very specific insight as to which of those companies might be the big 10x times returns, unless you have an insight, and they are hard, there's not many of them, there's a really strong argument to say, no, just get exposure to all of them, and that guarantees you participation in whoever the heroes turn out to be. Anyway, so that's reason number one, where you might think about, you don't need to pick stocks in the US. Reason number two is empirical. So for nearly 20 years, S&P Dow Jones Indices, at my company, has published a report on the performance of active equity fund managers. It's called SPIVA, and it's available for free to download. You just search the internet search engine for SPIVA, S-P-I-V-A, and you'll find the most recent ones as well as a lot of different ones. And this is showing you year on year what percentage of active funds were underperforming the S&P 500. And the answer that you get is typically around 60%. In fact, in recent years, it's been often more than 60%. And in fact, it has been more than 10 years now since the average active fund outperformed. Now, why or how is the subject for another webinar. I think the previous slide goes some way to explaining one of the reasons. But even if I don't sort of judge or try and understand why, this is what the data tells us. The data tells us that you are not disadvantaged by picking an index fund. In fact, you may well outperform a majority or even a large majority of active funds. So the evidence there says, at least in the US market, it's not necessarily a bad idea to consider just a low-cost passive investment. When we look around the world, we see quite similar, apologies, I've just got a poll. Forgive me. When we look around the world, so since 20 years ago when we started running these SPIVA reports, we've been busy and we basically reproduced that analysis for a range of global markets. So looking at the Canadian fund market, Latin American fund market, UK fund market, European, Japan, Asia, and India. And so what I'm showing you here are 10-year statistics, and it's the percentage of funds that were beaten by the benchmark. And you can see the benchmark here as well for each of those geographies. And what you'll generally see is that larger, more developed markets like the US and Europe, you tend to get over the long term, like a 10-year time horizon, it seems to be very hard for active to outperform. However, in smaller markets, it's more of a mix. You'll see, examples where, say, like Chile is an obvious example, every manager underperformed the benchmark. But in India, the record is a little better, actually. It's still a majority of active funds underperforming, but it's only a small majority at 65%. So that's telling you that 35% of active funds in India, they beat the benchmark. So still, not easy to find them, but easier, certainly, than markets like the US. And there is another reason that I'll just sort of talk about. So what's so special about the US market, or what's special about developed or larger markets? And I think you can see some indication of the answer here. Now, it used to be the case in the 1980s, 1990s, some of the 1990s, active managers had a much better record. And I think the key point here is that the market represents the average performance, right? And if some people are above average, then other people have to be below average. Otherwise, it won't be the average. And you need to think about the question, okay, well, who's going to be below average? In the 1960s, 1970s, and 1980s, in the US markets, the average investor was essentially an individual. They might be taking some of their paycheck and investing in Coca-Cola or IBM. Or they might be a retiree who's taking their shares in Coca-Cola and IBM and selling them once a month, whenever it was, to fund their lifestyle. When that was the case, it wasn't too difficult for a professional investor to have a real edge. You could read the earnings reports of the companies, or you could, read the Wall Street Journal and discern some macro trends, and you could easily have an edge. So you could be above average, and people below average were retail investors. And what I have on this slide is just kind of showing you how much that's changed, right? So daily volumes on the New York Stock Exchange have gone from 3 million a day to around 1.5 billion shares a day. How many analysts are there at the investment banks? I mean, none, 50 years ago. And now some of the larger banks have 300 each. CFA charter holders, subject, of course, very dear to the audience. Well, in 1960, there weren't any. The first came, I believe, in the early 70s. Today, there are around 150,000 chartered members of the CFA Society, and there's 250,000 taking exams. And then I've got some other things that I thought you might find interesting. So Bloomberg terminals have gone from none to 1/3 People involved in the investment profession has gone from about 5,000 worldwide to over 1 million today. Hedge funds, the smartest guys in the room. Gather that was the last webinar. When there was only $10 million in total invested in hedge funds, I believe that they could seriously outperform everyone. Today, there's over $4 trillion in the hedge fund industry, and that's reaching a point where they almost can't outperform on average because they're too big. ETFs, big part of this trend. So you can't be below average if you're tracking the index, right? You're not trying to beat the market, so you can't go too far behind. And because you can't go too far behind, you're not supplying outperformance to anyone else. And overall, the last piece, probably the most important one, institutional share of equity trading has gone from around 10%, right? So most was retail investors to more than 95% today. So there are some key ideas and trends around passive and active investing, and hopefully helps you think or try and answer the question about where indexing works. Now we're going to move to kind of what's next, right? The S&P 500 was built in 1957. What's coming next down the line, particularly for the Indian market? And we'll start with a little bit of theory. So this bit hopefully is familiar for everyone. It's a very, very simple concept. You can do it either by sort of regressing or statistical analysis. How much does my portfolio look like the market? Or you can do it on a holdings basis, right? How much does my portfolio overlap with the market? But in general, not just in equities, not in any circumstances, you can always think of a portfolio as being some kind of market exposure, right? Plus some things that you own that the market doesn't, or that you own more than the market does. And you have some active bets. And generally speaking, and in the context of everything we've been talking about, this market exposure, this beta, is available for you at typically low cost. It's nice and transparent. It's probably easy to get in and out of. And these active bets, they take harder work. You might have to pay someone a bit more money to do it, and they might not give you as much transparency on what they're doing or why they're holding it. So hopefully that's a familiar view, but the role of indices there is very limited. It's just to give you this market exposure, this beta at a low cost. But the world has changed. And now we are seeing indices that are looking at delivering very different features. So these include indices that are focused on income. I'll give an example of the dividend aristocrats. So this is an index of companies, for example, in the US. It is all the companies that have paid or increased their dividend for 25 years. So that's going to be stable companies that have a reasonably good record of paying a dividend. And it's a sensible way to think about generating income. And you can put it in an index, because I can write down the rules. It doesn't need anyone to do any active management. You've also got risk management, low volatility indices, selecting those stocks with lower risk. Investment styles such as growth and value have now been indicized. You've built indices that you can reflect those strategies. Diversification is even an area, multi-asset diversification, where there are indices that are encoding, fixed strategies, yes, but quite sophisticated strategies. And I'd include in that retirement planning. So that gradual evolution from high risk assets to low risk assets and thinking about inflation protection is something you can do in an index now. And of course, tactical opportunities. Do you really want to be right now picking one airline that you think is going to recover, or maybe you think airlines aren't going to recover, but if you do, is it not better to have a basket of airline companies and capture that global trend? That's something you can do with indices. And I think where we are today is a little bit more like this. So this is my sort of updated version of that. You take any general portfolio, and that is composed of 3 pieces. One is your benchmark exposure. The second bit is, you might call them factor tilts. It's indices that are often available in sort of low-cost products that deliver active-like performance, looking for income, looking for risk management, maybe even looking for momentum. But it's more focused. Right? It's definitely going to do what it says it's going to do. It's more transparent. You can read the rules and download the weights off our website. And because of all this, because it's just an index, it's typically lower cost. Now that doesn't rule out alpha. You still have or can have your alpha component, but now it's pure alpha. Now this is the stuff that you cannot get just off the shelf. It's that real insight or real ability from the best active managers. Just a few more comments on factor indices, and then we'll wrap up. So we have in the US, in S&P DJI, now got really quite a wide range of these so-called factor indices. The presentation is available for download if you want to get into or look at these a little bit more closely. But I just wanted to show you, in terms of that risk return profile, how much power there is in being able to select. So here, you have the S&P 500 right in the middle. You're really being given the potential to dial up and dial down risk, or dial up or dial down return hopes. And there's actually quite a good range of long-term options there in terms of generating risk and return. I appreciate many of these are not available as investments in India, but I do think ideas like this will be coming in time to global markets based on the interest we've seen in other regions. And then in terms of what's been happening this year, again, huge spread. So these are some of those factor indices that I mentioned, and just showing you what happened in Q2, where you see a big outperformance of growth and high beta, real recovery trade going on in the second quarter from March to June, and overall this year, who's been winning, and coming back to those themes that I mentioned about winners, just sort of winning all the way through, growth, momentum, being really strong. So even if you don't think about these as investments, I think these are really interesting indices to look at the drivers of market movements. So let's bring it home. A few applications, a few final observations, and then we'll open up for Q&A. So first of all, one of the things that I said to Srinivas when he said, what do you want to talk about? I said, well, I want to talk about important decisions. This is something that interests me, because a lot of what you do might be thinking about the active fund managers that you have, or maybe you are an active fund manager, and you think, what is the difference between picking a good fund and a bad fund? And just to take from our SPIVA data for India, and just to pick a representation. So over the last 10 years, the difference between a top quartile fund, i.e. in the top 25% of all fund performances, and a bottom quartile fund, right, just to get into the best or the worst, that difference on an annualized basis is about 3%. That's a lot of money, but it's only 3%. If you go back to the 4 assets that we looked at in portfolio construction, and I just take, the second and third, there's only 4 of them. So the middle 2 on an annual basis, difference between second and third, what was the average difference between those 2? That's 10%. That's 3 times more powerful in terms of thinking about your asset allocation. When we looked at the performances in this year, we're talking about industries. And if I take the information technology and healthcare sector, that's a huge difference. So they're 19% on average difference every year between those 2. So that's a really powerful decision, thinking about whether you want to be more in infotech or healthcare, and of course other sectors as well, right? So you've got even more choices there. And finally, on the big theme that's been running through this whole presentation, maybe think about having some allocation to the US and to the S&P 500, as a representation of that. With the longest history of any of the data I'm showing you, there's more than a quarter, 26% average difference. So that's a really powerful difference that you can make to your portfolio. Liquidity is sort of running through this, and I just wanted to say a few things about it, because one of the main challenges in portfolio allocation is actually getting in and out of positions. And while it might be, you know, a great idea to think about your favorite 1,000 stocks in the US, don't underestimate the value of transparency and liquidity. Indices like the S&P 500 are globally tradable names with futures, ETFs, options, index funds, and the media commentary, right? So if you look at the price of the S&P 500 or what comes in or out, there are thousands of people around the world who are scrutinizing that decision and trading it if they think it's wrong. And that's a real benefit to you as an investor. It's a benefit to you in terms of transparency and information, but it's also a benefit to you in terms of liquidity. It's very easy to compare your execution price on an S&P 500 product to something that is broadly available and traded 24 hours around the world. And you see this in, so just to show you what we've got on the left, you can see the average bid offer spread of some ETFs, exchange traded funds, all of them in the US, those linked to S&P's indices, and those linked to our household names, if you like, the S&P 500, the Dow, and the S&P 500 sectors. And the last thing, just before I share my conclusions, is a challenge to you. You know, think about what can indices do for you. They are not just a benchmark. They're not just something to watch on the news and see is it up or down. They're actually becoming power tools for portfolios. Thinking about accessing income with indices, thinking about risk management with diversification with indices, thinking about tactical viewpoints, thinking about improving the liquidity of the portfolio you'll hold so it can more easily manage, you know, inflows and outflows, and a few different ideas here for you guys to think about. But I'm running out of time, so I'll just bring it up to my conclusions. So first of all, look, a focus on domestic equity markets has not hurt Indian investors. Your local exchange has done fantastically well. Exchanges, I should say, have done fantastically well. And Indian growth does appear to be set, at least in the medium term, to be world leading. But even though the returns are good, that doesn't mean an allocation to international equities isn't a potentially great idea that can help manage the risk of drawdowns and can give you access to returns of sectors like technology that may not be as well represented in the Indian market. And when you're doing that, consider using products linked to liquid indices. They can capture a significant proportion of the opportunity set that you're looking for. And it's not necessary that you have to have a stock picker, you know, do it for you. Actually, just tracking the index would have done better historically. The evidence says, and it's actually not a bad idea. Probably will beat, you know, the average stock picker. And finally, you know, again, go back to my exhortation. You know, passive instruments, indices, the toolkit's expanding. It's empowering you, and not only is it empowering you in terms of access, it's also empowering you all to focus on the more important decisions. So I hope you found that entertaining. I hope you found that insightful. I have run up to the buffer on time, but I'm pleased to say we are now open for Q&A, and I'll invite our moderator back to pick some great questions.
Yeah, thank you so very much, Tim. It was a very engaging session, and I was trying to juggle between listening to you and, you know, getting the questions on board. But there's an enormous amount of questions, and thank you so much for the questions, very rich questions. So without further delay, let me get on to them one by one. And, you know, if I may request, if the answers are short, that is also fine, so that we can cover a lot of questions. Udit is asking where an Indian investor goes overseas, should she look at hedging the currency?
That's a great question. I would say that historically, at least, hedging the currency would be not such a great idea. And in fact, getting exposure to the US dollar or to some other currencies has been a pretty good idea. I'd say the only, and I'll make these answers short, the only qualification I would give to that is that if you're looking at investing in other emerging currencies, there has been some research to show that actually, if you're looking at very volatile currencies, it might be worth hedging it out because you get extra risks, but not really any particular extra return that you would look at. Obviously, it's going to be up to the individual, but yeah, historically, I'd say if you're going developed, it doesn't seem to be that much of a strong case. If you're looking at emerging or more volatile currencies, currency hedging can be a good idea.
So I'm just quickly moving on without reflecting on your answer. There's a lot to reflect as well. Number of questions have emerged on very concentrated returns within the indices. For example, in S&P, you've got the FANG stocks. In India, you've got maybe 2 or 3 names. Separately, I read a blog which said I noticed your slide where it shows that the ETF AUM has now exceeded the active AUM, the assets under management, right? So what do you think of these two pieces of the puzzle? Is the dog's tail wagging the dog now? The passive investing should be the dog's tail, right? And active should be the engine, but is the tail wagging the dog? That is question number 1. And the second is concentration within the within the indices.
Okay, 2 questions there. One of them, I might be able to very quickly keep the slide if I can find it. So let me talk about concentration. So concentration, and by that, if I just repeat the question somewhat for the listeners. So you have a situation today where some of the very largest companies have been doing very well. And the weight in the S&P 500 of a few names, Apple, Amazon, Microsoft, Facebook, and Google, Alphabet, so the top 5 names are now nearly a quarter of the market. And there are plenty of people who are saying, well, isn't the market getting a bit concentrated? Does the market start to look like it's got single name risk? And I'll say 2 things. First of all, yes, that has happened. It's been one of the extremes of the market at the moment. But I think what's really going on there is the value of essentially future growth. So with interest rates being very low, with the market environment being what it is, those companies that were already quite large have not only a sort of business model that's very protected against the downturn that we've seen, but also have that potential for longer term growth. And that's just attracted higher valuations right now. So it sort of makes sense that they have done so well. And in a long-term context of, looking back to say 1970s or before, these kinds of levels of concentration aren't hugely unusual, but they do ebb and flow. And so I'm taking too long to answer this, but I just want to make one more point on that. If you look at, going back to that skew argument about a small number of companies doing really, really well over the long term, and I mentioned Apple was one of those ones over the last 20 years that just had an extraordinarily strong return. Going forward, it's almost inevitable that, if there are companies that do 10, 20x the market return, they won't be the largest ones. Apple had room to grow 100 times faster than the market over the last 20 years because it started small. Apple cannot do 100 times better than the rest of the equity market, because if it does, it will become the entire US economy. And I'm pretty sure well before then, it will start to bump up against regulatory limits. So yes, the market is quite concentrated relative to history. No, it's not that concentrated on an absolute level. It's still a pretty diversified portfolio. And 3, you must expect that to ebb and flow over time as different companies, different sectors take leadership. And then in terms of the other question around, are there more assets now invested in passive funds than there perhaps should be, or ETFs? If I'm clever enough, I can try and share screen. If I can't, then forgive me. But hopefully this will shortly appear. So this is a chart coming from, so the US actually publishes this data as part of their national accounts. And what, if you can see it, and forgive it, it says draft on it, forgive me, but I think this is the one you meant, right, Srinivas?
Yes, I mean, not just a chart, but in general, right? So there's this, I mean, people are, the person who is a hero in Big Shot, right? I mean, he's saying, I forgot.
Oh, yes, he said, yes, yeah, I read that. So
yeah.
let me address that, because I do read a lot about, you know, ETFs are going to blow up the world or whatever it is. I have to say, I read it a lot less now, because we had the highest volatility ever in the US market. And not only did indices and ETFs hold up fine, they saw a massive amount of trading. People use ETFs and index funds to change their allocation as they may well have wanted to. The world changed. People changed their portfolios to reflect that. They used indices and ETFs in order to make those changes. And actually they did so in a very orderly fashion. And in fact, the story of that period in some ways was the ultimate proof of the ETF. And I think the cherry on the cake, if I can call it that, was actually the US Federal Reserve saying, okay, we want to buy corporate bonds, but the corporate bond market is too illiquid. What should we do? Well, actually, the most sensible thing for us to do is to buy bond ETFs. Right, so the US Federal Reserve kind of put a final decision on that. But to the question of, you know, how big are ETFs and are they wagging the dog? So this graph shows you, so it's ownership of the US equity market. So who owns the stocks? That big piece, the big gray piece in the middle, is individual households. And that really speaks to what I was talking about earlier, the decline of the retail individual investor, right? And the professionalization of the US market. In dark blue at the top, you have mutual funds. Their big period of growth was kind of the 80s and early 90s when they were doing very well. Then you have at the bottom international investors who are, you know, taking more and more interest, public pension funds, private pension funds, other, which includes, you know, charities and so on. And this little light blue bit here, just that, you know, the second from the top, that's 6% of the total market as of the end of last year. And it is not and cannot blow up the market. It's a very, very small proportion. What is true, I say again, what is true is that in many cases, ETFs can be used to get a nice, clean, transparent, at the moment, what's the price of the market, where's it going? And in that sense of being referenced by media, referenced by investors as you know, something you can watch to tell you what's happening, there I think ETFs probably have become something that, you know, you'll be hearing more about them because they're quite useful summaries. Let's give a really trivial example. If you look at you know, media in, say, Japan, well, the US market is closed most of the trading day, but there's an ETF in Japan which is still trading based on US stocks. So you can use that to tell you what's happening. It doesn't mean that it's driving the market. Anyway, I was supposed to do very short answers. That was a bit of a long one, but it's a very interesting question.
Yeah, just in short, to summarize what we are saying is that you know, the tail is not yet dragging the dog, which is the active investor. Is that right? Is my understanding right?
Yeah, absolutely not. No, yeah, it's not.
Okay.
It's not.
So how far is the problem away? You see, definitely not in India. My understanding is, you know, if you say that the tail is the passive investors, the passive AUM in India is very small compared to the active AUM, which is shifting. But even in the developed markets, what we are saying is that the tail is too small compared to the main dog, right?
Yeah, and look, to some extent, it always will be because, you know, people conflate or confuse the idea of a passive investor with someone who's using an index product.
Got it. So, Check, and I'm so sorry. I would really like to cover as many questions as possible. And folks, you know, people who are putting in the questions, I'm sorry, we already have the hopper full, but I will see if team who's already been gracious enough to answer so many questions and come on this webinar if you can answer these offline. The next one is, Krishna is asking, will active investors ever outperform? Will this trend ever reverse? Are the index not overvalued? So very short answer, Tim, if you can.
Yes, there will be periods and times when active does well. Look for a period when small caps do very well, and a period when there's very high dispersion.
Right. So one related question is the real alpha that outside the indexes with all of these ETFs? But is the real alpha outside the index or inside the index?
So there is always real alpha. The question is, how good do you need to be to capture it? There's always some funds that are doing fantastically well, but your alpha has to come from someone else who's underperforming. So the question is there alpha? It's who's getting that alpha and how hard is it to get? And in the US, for sure, it's really, really hard.
Maxim is asking, fixed income investment with yields near zero, how should one be thinking about it? How would you think about fixed income investment using passive? Very short answer if that's possible.
The shortest answer I can give you would be, from an asset allocation perspective, indices are still hard to beat. Our SPIVA data for indices gives very similar answers in fixed income. However, for individual investment portfolios, as you're allocating to time and bonds are coming off, and if you're laddering to meet, for example, someone's retirement, then that is something where the index solutions are still quite new or new to market, and they'll take a while before they're fully robust.
Andrew was asking a very interesting question. Globally, when active managers outperform, what is the median and mean return performance? My additional question is, what is the longest time period? Just off the cuff. If you have
median and mean, so that you don't see the skew so much in active performance, not as much. In fact, the skew is, most funds do okay, and then a few blow up. So you have negative skew. And sorry, the other question was, for a very quick answer?
Who's the longest, what is the longest period where you're seeing active has actually outperformed, and any couple of names where they have outperformed? To my memory, it's Buffett. I don't know.
Yeah, Buffett's a good example. Outperformed from 1960 through to about 2010. Has had a rough 10 years. From my memory, so just to answer from memory, I think the 1990s are a very good period. But for reasons that we've discussed, that might not happen again so easily.
Is the current environment good for dollar cost averaging versus lump sum investing? How do you think about that?
Pass. I think it has been generally not a great period. The trends have been quite strong, and so you want to sort of anti-momentum on dollar cost average. But I think it's really going to depend which market and which circumstances. Generally speaking, it's a perfectly well defended academically way of investing, and I think it's not just about performance. It's also about just sort of managing the risk of allocating at the wrong time.
Mary is asking, for the goal-based indices that you showed in one of the slides, where should people go and look for, actually investing? Is there a site? Is there a place where they can go and do this?
I'm going to pass on that one. I know specific funds which are available in India, but I'm also not I'm an index provider, not a fund provider. Perhaps that's something that perhaps you or someone else on the call can follow up. But certainly there are opportunities there to invest in these things, but that's not what I'm here to talk about.
There are many wealth managers in this call. And, are there any asset allocation tools that people can use online and, folks don't have that advanced math knowledge that you've got and experience you've got? So what's a quick way for people to think about, marrying goal-based investing and using those asset allocation tools?
Great question. The answer is there are, but similarly to the previous question, I won't personally recommend any, but there are some, and some of them are very cheap. What I can say, this isn't exactly an answer to your question, but I will say is on the S&P website, you can have something that will really help with that. All our indices have at least 10 years of daily data. They have sector allocations, they have all the information. You can use them, you can download them, and you can look at what's in there and think about whether it works for you as a complement to your portfolio. So that's not exactly the question. Yes, there are. I shouldn't talk about them, but do consider visiting our website. There's a lot of research, there's a lot of data that you can use to help you think about that.
Right. So, I mean, one thing about employability, there's a, some of them have asked employability of charter holders because of the shift to active passive investing. So what are your quick thoughts? Just one quick thought.
Sorry, on what? Sorry, on?
Because traditionally charter holders are about active investing. With the shift to passive, how should people think about their employability?
So I work with investors, many of them CFAs, around the world, and help them on their journey. And the thing I just leave you with is, hopefully you can still see the screen, the important decisions. So just because you may not be picking stocks doesn't mean you're not actively investing. Asset allocation is an active decision. Focus on income versus stability versus growth versus global opportunities is an active decision. Risk profiling is an active decision. Deciding which index you think is best is an active decision. And actually what it's doing is rechanging the focus from a very, very hard problem, which is the best stock, to a problem that's not easy, but it's more powerful. What should my asset allocation be? How can I, in a sensible way, be more transparent, manage my costs better, understand my performance better, right? And make more powerful decisions. So it is not the case that the process of professional investing is in any way challenged by indices, right, but it is going to be changed.
Right. So one last question. I'm sorry, we have run out of time. I hope I can get your help in answering the unanswered questions. What is it that you're reading currently, and any resources that you highly recommend for people to go and explore, in addition to your website, which has got phenomenal amount of information?
It does, yeah. I'll highlight, also we have a blog that actually has quite a lot of India content on it. It's called Indexology, and sometimes I post there as well. A great resource, kind of short little bite-sized pieces thinking about index investing. And personally, what am I reading at the moment? I'll give you the honest answer. I'm really enjoying, it's an old one, Frankenstein by Mary Shelley. Great book. So I recommend me from that. Not at all finance, but you can where our fear of technology, the human fear of what might happen with technology and the mad scientist and all those ideas, they all start with that book, Frankenstein, by Mary Shelley.
Right. So, thank you so much, Tim. I've really run out of time. I've run out of nine minutes. I hope folks have actually answered, given a feedback to our survey. They have also taken a look at the PDF that Harsha shared just a while back. This is Tim's presentation. I would like to remind people that we've got a very nice webinar coming on Monday, July 20th, which is on value investing and has the alpha gone away. Another brilliant speaker, Vitaly from Research Affiliates, will be speaking. I wanted to thank you all very, very much for your time in attending this webinar, to Tim and Bhavna and the entire S&P team to actually be here, as well as Harshad and Abhishek. Lastly, I just wanted to mention a couple of names. Vikas and Mahavir have been very helpful in giving me some of the questions that we saw on the hopper. Thank you so much. And that's the end of it today. Look forward to seeing you all again.
Copyright 2020. All rights reserved. This program is designed to give accurate and authoritative information in regards to the subject matter covered. It is distributed with the understanding that CFA Institute is not engaged in rendering legal, accounting, tax, investment, or other expert advice. If legal advice or other expert assistance is required, the services of a competent professional should be sought.